Hello and welcome. This is Raise Your Average. I'm Pierre Daillie, managing editor of AdvisorAnalyst.com. My co-hosts are Mike Philbruck and Rodrigo Gordillo from Resolve Asset Management, SEZC. Our special guest is Jeffrey Sherman, Deputy Chief Investment Officer of Los Angeles-based DoubleLine Capital, which runs $137 billion in assets on behalf of investors. In his role at DoubleLine, Jeffrey Sherman is involved in all aspects of DoubleLine's investment management, coordinating and implementing policies and processes across all of the firm's investment teams. He also serves as the lead portfolio manager for DoubleLine Capital's multi-sector and derivative-based strategies.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of AdvisorAnalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Jeffrey, welcome to the show. It's great to see you again. We're really excited to chat with you today.
Yeah, well, thanks for having me and look forward to a lively discussion.
Awesome. Definitely. So, Jeffrey, to kick things off here, please tell us about the arc of your career, how you got into the business, where you've been, and your role at DoubleLine Capital.
Yeah, so like most people that are good financial professionals, I stumbled into a career in the investment business. I started off on the academic route as being a mathematician. And like any good mathematician, I thought I would be a professor or a teacher at some level. And so I got a degree in applied mathematics, later went on to get a PhD in mathematics and realized that was not the life for me. I was, not interested in physics. You can't really get a PhD in mathematics without being a student of physics. And there was this interesting lecture that I attended on the application of mathematics to finance. And so this was the early 2000s, late 99, early 2000. And there was this big quantification, as they say, of Wall Street. And so I thought, that's a good way to pay off my student loans, a career that makes some money. So I ended up transferring out of the PhD program. Instead of just getting a degree, a master's degree, I decided to change career paths to financial engineering. And people at the time were like, well, I've never heard of this. And engineering is just simply applying mathematics to some field. So I got a degree in financial engineering, got an internship at Trust Company of the West, got hired on as I was an intern, finished up my degree. And as they say, the rest is history. On the career path working, I started in a risk group where we did a lot of ex post analytics, helping the marketing team digest it and really understand what's been going on driving performance. And so during that, I stumbled across one arm of TCW that I thought was very interesting. There was a gentleman by the name of Jeffrey Gunlock who was running the fixed income department, and just all of the analytics, all the things we saw in there were just super strong. And I said, it kind of meshes with my background. I don't really forecast a lot of returns. You look at cash flows, and it really just made a lot of sense to me. So I tried to get onto his team, and I did. I was able to do so and transfer over there. I started working in the multi-asset fixed income area or multi-sector fixed income area. And then the gentleman I was reporting to wrote one of the seminal papers in commodities. And so I helped him run commodity portfolios for many years before we left TCW. And I joined DoubleLine when we started DoubleLine. And so given it was a startup with 45 of us, there was a lot of redundancy and a lot of roles where we had multiple people for. So when we went to launch our mutual fund business, we realized that we came from the institutional world where, there's no such thing as licensing. You don't need a Series 6 or 7 or 63 to go out there and do that. And so, we're about a month out from launch and realized no one has the credentials to go out and sell the product that we're trying to launch. And so I raised my hand and said, kind of like raising your average. I raised my hand and said, I could pass the standardized exam. I'm happy to talk to clients. So I went and took the Series 7 about a week and a half later. I passed that, struggled on the 63. That one took a little bit longer to realize all those crazy rules out there. But I passed it about a week later, and I became our first licensed wholesaler at DoubleLine. So my first career, or my first role at DoubleLine, was a East Coast wholesaler. I chose the East Coast because there's more clients, more money. Figured if I'm going to go do it, I want to be with the best and the brightest. No offense to the other regions across the U.S., but that's why I chose that. After about 6 to 8 months, we started getting some traction. I went back to the portfolio management side. I gave up my Series 7 after about 8 months because we didn't have a conflict of interest to be licensed and running money. And so from there, I was a portfolio manager in the first year. And then in 2016, I was promoted to the Deputy Chief Investment Officer, where I oversee all those aspects.
Now that is a career trajectory in a nutshell. Well done.
So I did this in interviews with clients.
Wow.
Look, if you're really ambitious, you could go to Deputy Chief Investment Officer in under 6 years.
You're really not. Obviously, I'm not committed.
It's a different story than most. Right?
It is great. It's great. So as we I think it's just amazing that we've got Deputy CIO of DoubleLine here and talking about sort of asset allocation on a larger scale. And so maybe we could frame that a little bit within the dynamics of the expectations around growth and the expectations around inflation. We usually have those two dynamics on a sort of we call a target chart. It forms, the 4 quadrants, which are your, inflationary growth, your disinflationary growth, your stagflation, and your deflationary contraction type areas. And so thinking about the dynamics of asset classes through that lens, where are we today from your perspective in those growth and inflationary expectations?
Well, I think we've seen peak growth. And when I say peak growth rates, right? So nominal GDP is growing in double digits right now. That takes the inflation component into account as well. But we're just seeing crazy growth numbers out there in the marketplace that are because we've had, essentially unprecedented policies, both from the stimulus side as well as the fiscal side. And I think everybody's used that phrase unprecedented, right? Is that what you're tackling there?
No, it looked like the cat jumped. Do
you want to start off?
No way.
Okay. So, when I say unprecedented, I think there's been an unprecedented use of unprecedented, right? And so, that's kind of how we've thought about it. And right now, there's no signs of the U.S. slowing to where we're going to contract, right? Are we going to slow in our growth rate? Absolutely. Because again, remember, in the long run, you have potential for growth, and absent, similar stimulus levels we saw the last years from the fiscal authorities, it's going to be difficult to replicate those results. So I want to remind everyone that prior to the pandemic in March of 2020, the trend line growth was about 2.3% on real GDP. That's coupled with an inflation rate that was kind of stubbed to, or let's call it roughly 2%. So that got you to a nominal GDP of about 5, right? And so, that got you to at 4.5. So I do think that as we look forward, though, I think there is still some pent up things in the economy that can keep the growth elevated. And what those things are is that we still have a labor force that needs to come back to work, right? So there are 10 million jobs available. If you look at the JOLTS data, what the job openings data that the Fed uses. But we still have, 15 million people that are receiving some form of unemployment benefits. Now, will the 15 million people replace the 10 million? Not likely, right? Not likely, because ultimately there's a skills mismatch within the labor market. However, we've all been more productive today. If you look at where the trend line GDP is, we went back to trend growth, right? After the massive contraction we saw last year, and we've done it with fewer workers, right? So if you look at the workforce, the labor force, there's roughly 8.5 million or so people that were employed pre-pandemic that are not employed today, and that are actually defined out of the labor force. So what that means, we've been a more productive society. And is it because of technology and the likes? Probably, right? And so what you see is that the growth rate is likely to contract, but you're probably going back to not that 2.5%, but I'd say in the next year or so, we're looking at like a 4 to 5% real growth rate. Why? You still get decent earnings growth. There's that potential for the labor market to come back, and you're also seeing higher wages. So that higher wages gives people more money to spend, right? You know the formula from there.
Yep.
So we have been heavily relying on government spending. And I don't think that's going to subside. The magnitude will subside, but we're still talking about $1 trillion plans that are forthcoming in the new budget. And I'm talking about $1 trillion deficits. So all in all, the growth equation is there at least for the next 12 to 18 months. Now, the inflation argument the inflation component is much more difficult to distill, right? And if you listen to the proponents of the Fed, they're going to tell you it's transitory. If I look at my TV screen right now, David Rosenberg's on there. He's going to tell you we're in a massive deflation environment. And so I think there's a push and pull component within inflation. And so if you look at the headline number, it's kind of scary right now. People are cheering the fact that CPI went from 5.3% year over year to 5.2%. Wow. Right. That's what we're going to cheer about. But ultimately, there are things that are transitory within there. What's challenging is used cars, right? Used cars are likely to remain elevated for a period of time because we still have the supply constraints that are coming in new car production. And so that's a market that hasn't supplied today. But if you look at what's rolled over, things like airline tickets, hotel prices, leisure. Now, when I say they've rolled over, they're not growing at the rate they want. They may be staying put. So I think what's happened is inflation had a baseline reset, and these prices aren't going to diminish in most cases. Now, when I think about other pieces of inflation as those kind of transitory components, leisure, hotel, airline, we don't see any signs of those really rebounding from these levels. So that is transitory. However, I talked about the wage costs part of the equation, right? Yeah. The labor force, margins getting squeezed because of that. There is no end in sight in that right now. That is a positive sort of inflation though, right? Because if you think about wages increasing, who does it help the most? Typically, it's the lower income strata. They are consumers by definition. They're not savers because they don't have enough to go around. So this could still lead to a little bit more inflation over that kind of medium term behavior. Also, the supply side I'm talking about with the used cars and the like, those supply chains are not going to get rectified in the next quarter. It's going to take 12, 18, 24 months to rectify those as we redefine them. Listen to President Biden. He's talking about building new manufacturing and more jobs here to help control them. So I think as you look at the changing dynamics, the supply picture, I think that's going to ultimately lead to a little bit more inflation as well. It will cure itself over a longer period of time. It'll be offset slightly with higher wages, which helps the consumer. But on a real basis, maybe the consumer isn't doing much better. Lastly, is the big controversial point is the housing market. If you look at the Case-Shiller data or the FHFA data that came out last month, what you'll see is that you have record prints there, right? I mean, the record print, 18% year over year growth. One, that's not sustainable. But secondly, if you look at rents, there's a lot of pressure on rents as well. If you use the Zillow data, which we like as one of the best time theories out there, or I think there's another one that's like apartment price or apartment rent. I can't remember off the top of my head. You'll see that those are hovering in the high single digits. So after the rent moratoria, they expire, right, in various areas, you're going to see this reset. Remember, rents take longer to reset because it's when a lease gets renewed or the rent gets renewed that you see that. Why I point that out is that even though we're seeing high single digits in rent prices, and you're seeing the housing market do high teens type of growth rates, the year over year number and the inflation data on something called owner's equivalent rent or rent is roughly 2.5%. Now, you don't have to be very good at math to understand 18% is different than 2%, right?
Yeah.
There's a big gap there. Now, are they going to converge? Likely no. They'll converge at some point, but not likely to 18. So as the housing component, and housing is almost 40%, I think it's 35% of core CPI, right? That is going to put some inflationary pressure. It's going to offset more than all those transitory components that are either being flat or declining. So I know this is only one question and I've spent what seems like 10 minutes answering it, but the inflation picture is much more difficult to distill. And I think that you see this year a mid to high 4% CPI number, pretty easy to do in the third quarter here. So we forecast way more quartering than that. But I think next year inflation will go down. The growth rate will, but the inflation rate will go down. However, it's still going to be in the low to mid threes. So as you start to look at it, that makes you scratch your head now at Bayer. What am I finding attractive about a 130 10-year, right? What's so attractive about that? Unless you're a deflationist, unless you really think that the world is going to melt down. And again, September has been a little rough of a month for risk assets as it traditionally is. And so there's some reasons that you could see that in the short term, but purchasing power is very important for investors. And so some of these things, when you think about the growth and the inflation side, it makes you scratch your head about the bond market.
Yeah. And so what is an investor to do with that portion of their portfolio, that 40 in the 60-40 portion of the portfolio, given exactly the problem that you lay out? You have inflationary pressures and you've got this 40% of the portfolio that's yielding 0.5%, call it on average.
Yeah, it's challenging. So hopefully you're not buying bonds that only yield 0.5%. If so, we got some solutions for you, Mike.
Okay.
Except you don't like family, we can help you a little bit there. We don't have funds that really yield something north of the inflation print right now.
Right.
Dude, you mean you have to be extremely aggressive. And so, can you find assets that do that? Yes. They're called CCC high yield bonds, right? I mean, they're the junkiest of the junk, and you just got to hold your nose and hope they don't default. So you can be smart and clever there, of course. That's why we run, private placements and things like that. There are things you can do there. But to the average investor, you have to pick one of two paths. Either you hold your nose and you move out the risk spectrum on your fixed income portfolio, or you say, I'm going to be good enough for now, and I'm going to use it as a ballast and an offset to other pieces of my portfolio. And so I don't really recommend the former, right? Because that gets dangerous, right? Everybody's smart and said, I'm going to head for the exit. I'm going to be the first one for the exit when things start to deteriorate. And that doesn't usually work well. So what I think about is what do you think about your growth and inflation forecast? So if you come back and say, look, we're going to have a 4-handle growth and potentially a 3-handle inflation, that tells me a nominal GDP, I can put some ranges around, let's say 6 to 8%. 8's pretty aggressive, but 6 to 8 sounds reasonable to me for nominal GDP next year. And if that's the case, and I'm doing a 3% inflation rate, do I really think that the bond market's priced well to absorb that? That is, as the Fed steps out of its asset purchase program, as they start to get concerned about the level of inflation, they start to hike rates potentially. And I don't think hiking rates is on the docket for the next 12 plus months. I think it's like a 2023 issue, potentially at best. And so what's that mean? Well, as they step out, you get the largest supporter of the bond market leaving, potentially that puts a little bit of pressure on rates. And so what that means is you have to manage your interest rate risk. So what I would say is that either you go and you buy a piece of your portfolio that's a deflation hedge. It's called 30-year treasuries, right? There's an ETF for it out there. I don't recall the ticker off the top. I can't remember if it's TLT or TBT that people use. One's long, one's short. Be careful when you buy it. Make sure you know the right one. Like me, obviously I don't buy beyond funds. Yes. But you can buy a little piece of your portfolio to give you that offset for risk off. But why not generate some higher quality income? And so you can find things in the bond market that are short duration assets. Things we like in credit are things like the securitized market, backed by the housing market, for instance, strong market. They can be backed by the commercial real estate market. Commercial real estate isn't just, strip malls in middle America and office space in New York City. Remember, commercial real estate is the new economy as well. There's data centers, warehouses, telephone towers. They all benefit from the structure. On top of that, you have multifamily housing. It's another way to play the housing market that's strong. Also, the loan market is interesting. Bank loans come with below investment grade ratings, but they yield in the mid 2s today. I'm in kind of decently diversified portfolio. If you want to get you can get to the 3% range, right? Nothing wrong with that. If you believe that the economy is going to stay strong, and by buying a diversified, you don't really worry about the default risk. The higher end market doesn't offer as much value unless you're an idiosyncratic investor. And again, I think it's loaded with a lot of, it's loaded with a lot of the below the sub, the triple C component, the sub lowest rated tier that's driving the bulk of that yield. I mean, there are LB bonds that yield in a 2-hand. I mean, it's not really high yield at that point. It's yield, I like to call it. Rodrigo's agreeing with me, shaking his head. But at the end of it, you can actually go to the CLO market. Now, this is not for the average investor, but you can get it through well-managed funds and the like. CLOs just package up bank loans and redistribute out. You can buy triple B bonds in that area that have 3-handle yields. If you want to take risk, which we like in that market, double B CLOs yield almost 7 today, right? So there are ways of doing that, but sprinkling it all together in those kind of more non-traditional areas. But you need to balance that out with a little bit of treasuries, maybe a little bit of agency MBS, which is really just an interest rate trade, right? In the market, you got to be careful about the agency market. There's a lot of prepayment risk today. just given the dynamics of what's happened there. But in general, you can do things on the shorter part of the curve. So what are we doing? In general, I'm buying kind of that belly of the curve, medium type duration assets in treasuries and agency MBS. And I'm barbelling that with credit, right? I have a little bit of bias towards credit over that rates trade. I have enough rates to kind of balance out the portfolio, but I'm buying that credit has shorter duration, right? So the credit I'm talking about in the securitized space has a 2-year duration, 3-year duration, bank loans float, CLOs float. So what we're talking about is our credit exposure is not to the back end of the curve, it's to the front end of the curve, which doesn't have a lot of interest rate risk. One, it's shorter, but secondly, that front end of the curve is not likely to reset anytime soon. The Fed's got to get out of tapering, they got to get out of asset purchases before they even start hiking. And the 2-year will tell you a lot about that. So we're buying the 2-year bond that yields like 20 basis points, like clockwork, right? There's ways of buying assets that have similar interest rate risk. Yes, you take some credit rate risk, but you can barbell that together. So I think I like lower duration strategies, but what they're not going to do for you is protect that purchasing power. So what do, Mike? You look at the 60% to get you there.
Okay.
And as long as you don't have this massive stagflation, little growth coupled with moderate to high inflation, that equity side of the component can really help.
And on the inflationary side or on the inflation side of that, how do you see commodities playing into that overall structure?
Yeah, I'm a big fan of the commodity market still. We've had a good run up in the commodity market. And if you look at something like the BCOM, which is the broad commodity index, it's really struggled to break this like quadruple top it had. And it did just recently. And as I was telling the team, be careful there. Natural gas is 13% of BCOM and it's been on a tear. It's since relinquished. I think it's down probably at least 10% the last couple of trading days. But, be careful of looking at that. But if you look at the broad basket of commodities, they're getting close to that kind of quadruple top again. And so if you think about that and you go back and overlay this chart with the US dollar, right? You think, okay, commodities are getting kind of strong. There's got to be weakness in the dollar. This is in the face of strength in the US dollar. That's not a lot, but the DXY index that, people look at, it's up a few percent over the last 4 months or so. And so if you think about how well commodities have done in the face of that, in the face of the narrative that we have this global slowdown, in the face of the Delta wave, commodities have done relatively well. And so when you look at the supply side of the equation, what you find is that the supply side is not ready for a global reopening, right? The demand story has been a bit in China last year. This year, it's been the US. But who hasn't participated? Well, the Eurozone, Asia, and the rest of the emerging world. So once the vaccination rate increases, or we get to the dreaded herd immunity the hard way, one or the other, you're going to see a reopening, and that's going to cause for more demand side of the equation. So people say, okay, that's great, Jeff, but can't they just bring production? Well, the Saudis want you to believe that they can just put the straw on the ground and enough the oil and it just comes up. They just get 20 million barrels a day. But at the end, what you'll find is that it takes time to bring this online. There's been more discipline in producers in the U.S. specifically, right? Remember, heavily indebted with the shale revolution. The bulk of the high yield market at one point was made up of energy bonds, right? So what you've seen is more discipline there. And even with oil back to $70 a barrel, we're not seeing a lot of supply come back online. So I think that oil can flirt with a reopening of the global economy, triple digit oil again. The Brent price is always high prices. Then you think about the distillates are off of that. I mean, here in California, I was in New York last week. I was amazed to see 3-handle gasoline. We're close to 5 up here in the high price there. I mean, we're a highly taxed state. We know that, but man, it just feels like pain. As one analyst asked me the other day, how come in 2008, oil prices hit $140 a barrel and gas made $5? Now here we are at $70 a barrel, and it's back to $5. To which I said, well, actually it's 47 just to be a smart aleck there. But also there's been a tax regime, but also it's the production side, right? It's the production side of the equation breaking it down. Also look at the mining sector. If you look at the metals, the industrial metals too, if we're going to have a global expansion, which it seems like everybody wants to have, you're going to have this dynamic where that's a supply chain that can't come online quickly. how easy is it to drill a hole in the ground and mine for ore? Every time you mine, it's a little bit more difficult, right? The marginal cost goes up. Secondly, it takes 3 to 5 years to bring a mine online between the digging, the paving the roads, the smelting plant to bring it in. And by the way, Mike, don't forget, there's that input cost of energy to do the smelting. So what you have there is really a bad dynamic in the industrial metals. So even though we've seen some relinquishing in prices and things like copper, we're seeing new highs in things like aluminum, right? Or it's the rest of what called the aluminium, right? You see it in nickel prices as well. So I like the oil sector. I like the industrial metals. And unfortunately, food prices are likely to continue. With climate change, the way you see it, no matter how you shake out on that, it's destroyed a lot of our crops globally. So from that perspective, owning a basket of commodities is pretty dang attractive today. And if you believe the dollar goes down, and you think that there is going to be more global competition, I think the catalyst for that is the reopening of Europe. That'll put pressure upward on the euro. And when that happens, I think commodities are set to take the next leg up. Is it this new secular bull market? I don't know. It depends on how you define it. But I do think that the setup is there, and it's a good way to play the inflationary component as well.
This is actually about the, oh, go ahead, Rod.
Yeah. So this is actually quite a timely discussion because this morning we played a clip that we had with Chris Schindler from, he used to be at Teachers and used to be the tactical asset allocation guy at Teachers pension planning in Ontario. And he was talking about commodities and discussing why do commodities tend to trend? What is the underlying reason why commodities do this? And he talked about it from the perspective of operations research, right? Order of operations. How do you deal with queues and lines? If you have a couple of cashiers that can handle one customer every minute, and you get on average a customer a minute, but you add some stochastic noise there where they're coming at different times, what you end up having when somebody comes in before the minute is a longer and longer queue that then have to be relieved by the cashiers over time. Eventually it'll clear. And the traditional markets, when you're talking about businesses that have only a few cashiers, is that you can modify your supply. You can add cashiers fairly quickly. However, in the commodity space, you cannot add cashiers very quickly. If there is a increased demand because, as you mentioned, an opening up of the economy, the ability to add cashiers takes 3 to 5 years. And that's why these things tend to trend. And then, of course, you have an oversupply problem 3 to 5 years from now. We have too many cashiers, and now you're clearing people faster than a minute, and you end up trading or trailing over a negative trend. So certainly the quant element that Mike and I represent is quite in line with your analysis right now. There's going to be.
Yeah. And, he's obviously a very smart guy if he just knows stochastic, right? So, I mean, that's the key thing. But you're absolutely right. And for those who don't understand that dynamic, I say happen with just-in-time inventory.
Right.
Think about what's happened in markets out there. And we're all realizing that today, that it was great to be able to rely on your supply chains and your suppliers to give you stuff overnight. But when that breaks down, you have significant risk. And the other thing about the inflation component, and it's on that same topic, Rod, is that what you find is that what we haven't seen yet is a restocking of inventory. Yeah. I want to talk about that. That's a huge piece. Even though people are and businesses are restocking, it's getting sold out almost instantly, right? Or very quickly. And so, for those that are in the deflation camp, typically, if you see a high level of inventories, that's the signal, not the fact that you have depressed inventories, right? As long as consumption, depressed inventories are only deflationary if we're mired in a recession, which I don't think any of us would think here that we're in a recession, because remember, the NBER came out, I think it was in July, they came out and said that they declared the recession officially over. And the date of that recession, it started at the end of February of 2020. And in July of 2021, they declared it over. Backdated to what day? April of 2020. Well, thanks NBER for that clear signal and spending another 14 months to tell us that. But I think that your metaphor analogy of the cashier is perfect for the commodities market. And one thing I want to touch on, and I think Mike and I were talking about this before we started, is people look at the commodities futures market and don't really understand the signal you're getting from it. There's a lot of misconception about it. And so when the commodity market trades in what's called backwardation, it's just a fancy word like stochastic that makes us all sound academic and to try to pick on your word there, but I've been a mathematician. I took a lot of stochastic calculus. But what you see is that backwardation just means that future prices are lower than current prices today. And so when you first look at that, you would say, the market thinks prices are going down. No, what it signals to you is low inventory. There's more supply than demand, and the market demands a higher clearing price for that commodity today. The opposite, contango does not, when it's an upward sloping term structure, does not forecast prices are going up, but indeed says it's an oversupplied market. The equilibrium point further out is there. And that's why if you actually look at commodities, if you invest long on the curve, so if you got 12 months out of all those positions, you actually save a lower volatility point than if you invest in front month. Mm-hmm. Why is that? Well, the market clearing takes place spot month. Yeah. All bad things and good things happen at the front month, right? Supply comes online. Well, let's say with nat gas, we have huge climate disruptions, right? That we've seen with the hurricanes and the likes. So in general, I think that when you look at the backwardation throughout the commodity complex, even on like a naive index basis, and we're biased, we manage portfolios there. But if you look at it, it's some of the best backwardation that you've seen in probably 15 years. And so from that dynamic, that is accretive to investors. If you buy a futures price that's lower today and prices don't move, that means you will up the price curve. You make money from that position. So I think there's a big misconception about that. And when you see backwardation, you got to think about it though. Is there a reason it's that way? Is it like lower futures where it's just a massive shortage on the front end and it's going to clear itself together? So I really want to take pause and really take a shot at those people that are saying the commodities market's weak. Look at lumber prices, look at these one or two commodities that have been down. And if you look at the basket of commodities, the only thing down month over month last month, if you look at the basket that goes into CPI, it was actually lumber. So I think, people need to really take a harder look at that and understand the setup that we have.
Mm-hmm. How are you seeing precious metals play into all this, Jeffrey?
That's a tough one because I think the precious metals have one equity in that, and that's called cryptocurrency. And why I bring that up, you can't have a podcast and not talk about crypto. You can't have a discussion.
I knew we had to get there. That's right. I thought you'd.
But the thing about gold is that and I'll start with that one, is that it has a traditional buyer that's found the crypto market. The people who don't trust the government, think the inflation data is simply higher, they're using crypto in some of those ways. So again, take what you want out of that. But in general, I think that gold is a little bit challenged. I still like owning gold. I think it has what I call biblical street cred. It's worked for, many thousands of years. If you look at the other things that were in that biblical reference, they haven't done so well. But the gold has continued to hold on there. I think you play the gold trade, play silver. I like silver better because it has a higher beta to inflation traditionally because of some of those industrial components. And the gold to silver ratio is pretty elevated. And even though it's off its high, that ratio, it still looks pretty attractive today. Then you have the platinum and palladium too. And some of that feeds into the catalytic converters on autos. Look, we're still going to have the combustible engine for the next decade or two, or maybe 10. These technologies, electrification of cars, it's going to help. But some of those metals need to go into that process. Obviously, copper is a big component in there. Lithium and things that people trade on that side are pretty attractive for the electrification trade. But, the precious metals, they haven't responded well to inflation, right? You haven't really seen that recovery there. But I do think if you see this kind of medium-term weakness in the dollar, it will kick back in. But of the four, I really like the silver trade the most. They call it the poor man's gold, but it has twice the bulk. So you got to size it accordingly. So if you're a traditional gold investor, you want to do half of what you would do in gold in the silver component.
And how do you see ESG playing into all this? We've had, a long discussion about commodities, about copper, nickel, everything that's dirty and has been a part of the carbon challenge. How do you see that playing out?
Well, that's a very complicated question. And it's complicated because you said ESG, but really what we're talking about with commodities is E.
Yeah.
Right. And I guess some of the social fabric to it, especially if prices go up, especially on foods. But where's the G in it? There's really no governance really on that side of the equation. So you're really talking about the E.
I'm sorry about that.
Again, not to be,
You're right.
Nancy can dig into it. But, and I asked the question is that, if we're going to electrify, we're going to have to pollute to get there. Now, should we do it? Absolutely. Should we try to protect the environment? There's a guy by the name of Ben Hunt who put out the, billion tree project where he's trying to do 100 billion trees planted a year, and they had some scale up there to get to 1 billion trees in 10 years. So it wasn't 100 million, it wasn't linear. But maybe it's 10 billion and he starts at 100 billion. It's a lot of trees. Okay. But if we talk about the lifespan and what it takes to offset the emissions for a vehicle, and you're talking like 40 years of one tree. So it's not something we're going to cure overnight. But I say beware, of a lot of people peddling ESG. It sounds good. We all want to do well, but is it really there, right, in the process? And so, yes, there are some people that do it extremely well. Someone sent me a VC fund that's only on these newer technologies trying to be ESG friendly. And so I think it has a place, but it's not the end all be all. If we really want to fight this stuff, we need it from the political level, right? We need to get together and do it. Not just the investors that do it. Yes, the flow of capital needs to move in the right direction, but I'm challenged to see why ESG should generate a higher rate of return, right? I think it actually generates a lower rate of return because we've bid up the price of those assets. Think back to the low wall funds when they came out, right? When they got really popular. They've been around for 30 years. The betting against beta factor, I think, I can't remember, was it Sharp or Markowitz? Someone wrote about the 70s, right? That on a Sharp ratio basis, the low ball outperforms. And so what you find though, is that when those became very popular, they were outperformed because money flowed into them. And so when you look at it, I think there is merit to it. So I don't want to dissuade anyone from doing it, but also know what you're buying. A lot of them just have ESG stickers on it and they own some of the worst polluters in the world. Well, how can they do it? Well, Exxon, they divested, it's Exxon, no, it's Texaco Chevron. They divested this plant in, this drilling field in Alaska, right? Because it's a bad polluter, right? So they get kudos for doing that. It's great for them. They get no disrespect to what they're doing. But then you go, who they sell it to? They sold it to a wildcatter in Texas, right? And again, double fits to more wildcatters people in Texas. But the guy's doing it even worse. The emissions are like 2x what it was before. So is it in better hands now? Or are we better off? And so, this little, electrification of vehicles, it depends on how we generate the electricity. So I don't have any ESG centric funds today. Yeah. But one thing I've done is that actually, in about an hour, I had someone coming in to finish out my solar install in my house. There you go. Everybody's trying to do their part. I think that's a better thing. Yeah. We can think about it. Should it be the end all be all for investors? I'm not convinced. Yeah. And when I look at ESG on the equity side, what I find it's highly correlated to the quality beta. It's really the G that's driving. And again, I think the S is important. We saw that the fabric of society changed last year. Think about the social injustices that are coming to light. They've been systemic for many decades. You're starting to see that. So I think education, being better people, and put on the forefront of everyone's mind, I think we all become ESG over the long run, right? Because it's better for society. Yeah. And so I think that's the goal. Remember, we're all capitalists, and capitalism needs a little regulation. Otherwise, they become blunt fraudulent activity.
Well, it's certainly interesting to see everything that you just said is absolutely true. And if you put your ESG hat on, you're going to be able to participate in that and see how it goes as it grows. But as an investor, if you put your investor hat on, and we do have a similar outcome as the betting against beta, that low volatility aspect where a lot of money flowed into it, they kept pointing to their performance, and ESG is going to continue to point to their performance. So if you invest in ESG, if you're a responsible investor, you can do a lot better. Now, I don't know what part is true, whether it's the actual ESG or if it's money flowing in because it's popular. Regardless, as an investor, it's something to think about from the momentum aspect of things. And hey, you never know. You might actually educate yourself on that and start buying some solar panels for yourself as well. And so it's an interesting space for sure.
Yeah, well, I got tired of Powerbridges here in California. That's another thing.
Yeah.
We seem to have all the time. We hear fire season as well, so I'm kind of concerned about that component. But I think there's a lot of evidence that says something's going on with the globe. Right. And, the carbon footprint is heavier and heavier. We know we're changing the dynamics. And so I think that to me, that's the key thing. It's like, look, am I going to go out there? Think about sin stocks, right? If you follow Shura law or, you're an anti-sin, you're a church and they avoided like the plague. Wow. That's one of the best performing stocks over the last 20 or 30 years.
Tobacco.
It's tobacco. Yeah. Right? Some of the best bonds, tobacco litigation. Right? Because people avoid it. And when people avoid things, it creates incremental risk premium. Again, not saying that you should build a portfolio of nothing but polluters and social injustice, totally ran companies. If so, I probably buy gold miners, that have basically the worst companies and y'all know that they're polluters. But they don't have that social injustice component. But in general, you got to ask what you want for things. And so, if you make better returns elsewhere and you can do good elsewhere, isn't that really the same thing? And again, I think pressure on companies, it needs to come from society. You're seeing that, right? The social injustice movement, to me, is a big piece that doesn't get a lot of merit in the investing world. Why? It changed behavior. Think about the All-Star game for baseball. I know no one watches it. It's one of the best competed All-Star games because they actually try, right? The pitchers are not going to give up home runs. They just want to hit, right? It's actually one of those where they actually try. It got moved because of some of the policies going on in Georgia, right?
Yeah.
So you find these things that it takes all of us to work together. And it's always not just like, oh, I feel good because I bought an ESG fund. What are you really doing to change that dynamic?
And what do you think? So on the environmental side, coming back to that, sort of solar and wind is not going to change it. Do you have any thoughts on nuclear or how that can play a role in this, or anything from that commodity side? A very narrow commodity, obviously, but any thoughts on that?
Yeah, I don't really have an opinion outside of that. I know we've decommissioned a lot of the nuclear plants here in California. I had a friend that worked at San Onofre, and they shut that down probably 5 or 6 years ago. So I don't really. I'm not a physics expert. I don't really understand the whole fusion component and everything, and so I'm going to take a pass on that.
No problem.
I think uranium's super popular. But to Rodrigo's point here, there's been a lot of fund flows. Look at those two ETFs.
Oh, yeah.
There's been a huge increase in that. And so, again, I think we need some of our Canadian friends to come on to talk more about uranium, the nuclear control.
Well, I think like absolute power, fund flows corrupt absolutely.
Yeah,
and it's just a flow of funds.
My corollary to that is fundamentals come home to roost, over the long run. Technicals will drive markets in the medium term, but absolutely money flow is the most important thing in the short term.
Jeffrey, you run equity strategies based on cyclically adjusted PEs. What sort of insights are you getting from your strategy?
Yeah, it's starting to finally signal that value sectors are becoming cheap, or cheaper. There's nothing absolutely cheap out there in the market today. I was listening to Chanos on TV this morning. He's one of the few guys I'll turn the volume up for. Legendary short investor, and he's talking about one of the casinos. I won't name it, and just how if you look at their Chinese operation in Macau versus what you see in the U.S., investors have been flocking to it because of the 9 PE ratio. But if you look at it, well, the bulk of like 70% of the revenue is coming from Macau. So if you value it on that basis, it trades like a 25-30 multiple. So I think what you have to look at is overall businesses and viability here. What we're seeing is the cheaper parts of the market are things like financials, right? Why are they depressed? Shape of the yield curve. There's been some regulation there that's driven that. And again, it's been highly correlated to the rates trade in the last 3 or 4 months. If the curve's flattened, they've struggled a little bit. Not to mention just banking pressures out there. But also we've seen things like REITs that screen a lot cheaper, which a lot of people wouldn't suspect. We've seen healthcare as well, which is kind of a traditional value sector. And for the first time in a while, we're not invested in IT, in information technology, through this profit. And so it's gotten to where it's more expensive than it had been. And so you start to look through the data. What it's telling us is that it seems to be a more value-oriented market. And I put on my rates hat and I look at, a 130 10-year and I perplexed. Now, as we talked about the corollary out there, it's technicals, fund flows. Fund flows come from none other than Jerome Powell and his cronies, right? The technicals are, we got rid of the special leverage ratios, the SLRs for the banks. They had to buy higher tier one assets at the end of the first quarter. They started buying treasuries and mortgage-backed securities, right? That put some pressure in there. In fact, mortgage spreads got super tight. We got to some of the lowest weight we've had in our flagship fund in like decades in agency MBS for that reason, just they got ugly. From our perspective, we've since been buying a little bit more because those spreads have widened out. But what you see there is that dynamic covered with how strong the equity market is. There's some rebalancing and you saw demand from foreigners. That's more true fund flow. So you put all this together and that got us like a 40 basis point rally in the 10-year over the course of. So, okay, most people missed that. We didn't really get on board with that trade. And now we just think that the rates market has been really, really narrow out there. And so if I put on my raise view, I look at inflation, I look at nominal GDP growth, it says that the 10-year, all of our fundamental work we do shows the 10-year view somewhere between 2.5% and 3%. Okay. That quote rate has something to do with that. Rodrigo was famous for saying QE took about 60 to 75 basis point off the term premium. All right. So that says, okay, maybe we should have it to 250 10-year, right? Something like that. So we're a long ways from that. Right. But if that happens, some of these value stocks and value sectors are really going to have their day. And so I think that's what I'm waiting for here. It's a different view than most people think about. But it really sits into, again, being an allocator, someone has to look at all asset classes. I think it's how you think about it. And remember, the rates trade is a value trade. Therefore, I think, right? I'll look at tech. When rates rally, tech gets hit. Now you have the Chinese news. That's, that's something else. We'll leave that for another discussion. But in general, you're starting to see that there are signs emerging that maybe the value strategy does have some more legs.
Well, maybe you should have had a little bit for the listeners. I've had this discussion at times where we talk about the correlation between value and rates, but maybe talk about why it is that growth stocks don't benefit from a rising rate environment or period.
Yeah, it comes down to growth. And that's the misnomer of growth stocks, right? When growth is scarce, growth does better. When growth is plentiful, value, things that are cheaper do better, right? Because there's a broad participation. And so that's what's missed in this. And if we get a reflation trade, that means the scarcity of growth it is subsiding. Think about the last decade. What did you have? Great scarcity. What did we have last year? A growth scare. We haven't had technology on the growth sector that really helped bail things out too. If you look at something like the NASDAQ last year, right? So a lot of people don't realize that reflation trade is a value trade. In fact, value is higher correlated to growth than growth stocks. And again, I just think it's a misnomer on how people do it. But the growth comes from, what you're paying for the multiple, right? You're paying for growth and it's usually a scarcity premium than necessarily the value side of the equation. People think when growth is scarce, you want to own value. No, it's typically the converse. That's my simple explanation. I don't know if that works for you, Ravi.
Well, what do you mean by scarcity and growth? Maybe unpack that for me because I didn't quite follow.
Right. So when you have a low growth environment, you look for sectors that can outgrow other parts of the market, right? So you want the things that grow faster. When you have this kind of a depressed valuation, typically that means that you've had a challenged environment. But when you have a reflation trade, that is, things are coming back. No, it's not value dead. Once, the idea that growth was going to come roaring back. The anecdote is look at the data from, roughly a week after the election, right? When we actually got the results of the election, right? To, the end of the first, when we're getting this big, great boom, that's what value really took off. And so what I mean is that it's certain pockets that are growing. Now, can a sector turn from value to growth? Absolutely. But think about industrials, which aren't necessarily classified in the growth sector, right? We didn't have, right? Think about things that, you have high capital intensity for. Those tend to be more value oriented because you pay less for those dollars.
Right. That makes sense.
Yeah. So the way I'm understanding it,
okay.
The way I'm sort of hearing it is that, in the time when the economy was in question, tech stocks did extremely well because, for example, because there was a sort of low growth outlook, maybe even deflationist, and interest rates were being driven down, and because the tech stocks are high duration, they're also being driven up.
That's a better point too. This may simplify it, Rodrigo. He nailed it there with duration, right? So if you have a high multiple, that means you need a longer time to get your money back. That's what we call duration in the bond market. And so value tends to be a shorter duration asset. And therefore, in a rising rate environment, in the bond world, you want to own shorter duration assets than longer duration assets. So that's like the bond. Now, I feel like I live too much in the bond world that I'm always trying to use those analogies. So Pierre is bringing it back there. It's really the duration of the cash flows. And if you pay 40x or 50x, it's a long time to get your money back. I'm going to say, well, it grows. But if you're paying 40x for that, remember duration, very simply, is the present value of the cash flows. How long does it take you to get your money back? Right. And if you think about it from that concept, that's the kind of the interpretation of duration versus the mathematical one. And that's exactly what Pierre's pointing out there on the technology sector.
Yeah, perfect.
Yeah. So when, as you said, when the vaccine news came out, all of the growth targets changed, and there was an outlook that rates would start rising, right? They would recover off the bottom. And then as they recover off the bottom, duration assets would suffer.
Yep.
That was
right. You saw bonds suffer, and you saw the shorter duration sectors do quite well. The bank loan market, the high yield market outperformed investment corporate bonds. Now it's worked in the second quarter, right? And part of the third quarter is longer duration assets, right? So same thing. You see tech booming again. You see investor grade corporates kind of outperforming there. Although duration hasn't moved a lot the last couple of months, we've been kind of mired in this range. We broke out the range last week, and then we get this growth scare, out of China today. And, a lot of people saying the canary in the coal mine, or, they're using the analogy that this is the Lehman moment. I don't know how many Lehman moments I've seen in my career. I only remember one of them actually, but talked about a lot. And look, are there some ramifications? Absolutely. Guess what? You know where the bonds the bonds trade today? What's it? I can't remember, the names escape me. Was it Evergrande? Is that the name of the company?
Evergrande.
Yeah. Evergrande. Yeah.
Evergrande.
I don't know. I tried it all day with that name. I couldn't spit it out. It's nothing but a headline. I can't remember it.
I think if you go to Starbucks, if you go to Starbucks, they might be able to help you. But
the thing is that whenever your bonds were trading before today, 20 cents on the dollar. Do you think this is news? Sure. There's some headlines about every day. Guess not. The sovereign entity is already looking to bail them out in some capacity, right? So look, it's like the Japanese were in the 80s and early 90s. They're going to bail out the real estate industry. So like, is it contagion? Sure, it can spill over to a few more names. It can give us a little scare, but don't forget, there's a lot of money backing that entity, and it's called China's balance sheet.
Mm-hmm. Exactly.
Yeah, they're not going to let that.
Yeah, the question is whether it's systemic in the way that Lehman was systemic, right? And this is what people forget. It might have been as big, it might have been levered as much as Lehman, but the interconnectedness of that Lehman market, well, whatever the mortgage-backed securities were, was a global issue in a capital market. We're dealing with Evergrande, ever growth, ever everything. Then you might be able to protect, right? By this
a different time where regulators and government agencies are far more willing and able to intervene at levels that are unprecedented. Look what they did recently, right? That was emboldened by what happened with Lehman. I mean, they were emboldened by all of the things that they've done in the past that worked, which allowed
China bailed us out then. They're going to bail themselves out now.
Also, you think about it, like it was Evergrande, EG, we'll call it today. look, there's going to be, some knock-on effects from that, no doubt, within the Chinese real estate market, right? Because people are going to run for the hills and see it. When you have almost $2 trillion in debt, they did that. But also what they do, they're not just a real estate company. Right? They stand into financial services. They're a tech company. They're the everything to everybody. So, this is one of the challenges of running those type of businesses is that they essentially gave up all their cash flow to grow. And very few companies can do that. And the only one that comes to mind is Amazon, right? They're the ones willing to take a short-term loss to do that, but they didn't do as much as fast as EG, as we're calling it. Again, I don't know how to say it. I was clear.
I think it's gone. I remember Grande Venti or something like that. A little Starbucks humor, I guess.
I think what is the largest cost?
Venti, that's one. They're trying to pay. They want it to go Venti. Not allowed by the Chinese government.
You can tell a big Starbucks consumer. I just go to the kitchen, man. It's it. And right from home, that's the one thing I miss is the coffee at work. I actually had to start buying coffee at home. So
I think that's happened to all of us.
Jeff, you actually run a really unique multi-sector equity strategy, right? I mean, it's based on the cyclically adjusted PE ratio, and then you apply that across all the sectors. And then how does it work? Because it's been quite a successful strategy, and what are without giving away your secret sauce, of course. What do you think is what are the mechanics of it in a nutshell?
In a nutshell, what you find is that, sectors of the market are treated very similar to individual stocks. Even before the meme craze, right, or the Reddit army, as they called it this year, right? People love certain stocks and they loathe others, right? And we find a very similar aspect within parts of the market. And I used earlier industrials, right? What's the old adage in the US? What do you hear from people across the country? You hear that we don't make anything in the US anymore. I hear that all the time. We still have an industrial sector. It's just not what it was 50 years ago. We still produce cars. We still produce copper and iron ore. We build buildings. We do industrial activities. And so that narrative is more overpowering than the fundamentals. And so what that means is that there's a behavior aspect to it. And one thing that we saw when we looked at the research from Professor Schiller on this was that you couldn't explain the excess return of this type of strategy relative to the S&P by just distilling it down to factors, right? The first thing I thought of, it's just a value strategy, value. Don't bore me with those details. And so with one of our analysts ran the data on this. I said, no, you can't get that. You get all this residual return as alpha. So they'll get the QMJAG, with the BAV, the betting gets fair, the quality factors. Let's throw the locations they get. And by the way, did you do it right? Send me the data. That's always when it doesn't look right to me. That's the first thing I ask. And then I said, wait a second. I don't. There's something there. And so as I look across it, and the team started to dig into it, we started to think about this, like the behavioral components. We looked at what did it own in certain periods? What were the themes? What was the thematic trade of that year? And what you find is that the thematic trades, they work as they're burgeoning, right? The ideas, think low bell, as we said, think the cannabis stocks, right? Think the meme stocks. When they take off and they start, that's when you want to be in it. By the time everybody knows about them, they're usually kind of done in their trade. And so what you're essentially doing is counter trending some of the stuff. So it's value from that component. But the other thing I gleaned from it is that why can't growth be cheap? Why can't you get a period where growth sector is actually cheap, right? And so applying a valuation metric to the sector was something that I'm sure someone else has done. I just had never seen it work that way. And so what we found is that, it's an interesting idea, but we wanted to be an active manager. It's in our blood. So I can't actively manage around this idea that Professor Schiller had. He's too smart for me. He's got it. It works. I like it. So what we decided to do was, let's do this synthetically. Let's get a swap on this exposure, and let's do what we do best. Let's run a fixed income portfolio underneath it. And to my point earlier, just run a shorter duration asset, right? Run something that's not exposed to long in the bond market, because if we have a growth environment, and that typically means higher rates, your bond portfolio is going to do poorly. So keep on the front end of the curve, do what we do best. Let's allocate across sectors to the market. Let's find the best ideas on the front end of the curve. And don't be just wedded to owning treasuries or owning investment grade corporates, but open it. We own emerging market debt in it. I feel like people always come to me and go, how can you say it's a low risk portfolio? What high quality corporates that are primarily investment grade with short duration? Sounds like good companies to me with a bad address, right? So yes, it has a little bit of an fault. Manage that accordingly, size accordingly. So what we ended up doing was build the bond portfolio. Our objective is to do, cash plus 150, 200 basis points per annum. And if we can do that, that outperforms our funding cost on our swaps. And what that allows us to do is be a creative structure. So you're indexing, right? Or you're smart baiting, if you like that phrase. But I'm doing smart alpha on the bond side with my team that allows us to try to outperform. So I have no problem with you indexing, right? But remember, you're always going to underperform net of the fee, right? Unless you get a negative fee ETF, which I love the marketing hook of those, by the way. Negative fee for the first year because you're going to forget to sell it when the fee goes to the high level status, right? The idea is to generate some alpha there. So if this process can generate 100, 200 over, we can do something like that as well. All of a sudden, you have something that can do 200 to 300 over an index, which is not chump change. And so that's what we tried to do. We're not successful every period, but generally it's been a long-standing track record. We're doing it for almost 8 years now. In fact, next month will be the 8-year anniversary of this.
So Jeffrey, just to be clear on the what you meant by the swap and making sure that you can make returns over the funding rate, you're getting full 100% exposure on the portfolio to underlying factors, and then, or basically you're buying an actual bond portfolio and using that margin as collateral, those positions as collateral to buy the factor swaps.
And how much so exactly? So
what type of leverage are generally, I know it's a bad word. Well, I love it. We love it. We talk about it here all the time, but what would you think the notional would be on the two stacks?
I know exactly what it is. It's 100% and 100%.
Right.
So I'm 100% fund, right? You give me money, Rodrigo. I put it in this bond portfolio. I own some cash. I own some treasuries that I hold my nose, but they allow me to do margin and stuff like that. I build this portfolio and then I go out and get 100% exposure to this index. This index is a systematic process that gives me exposure to 4 sectors of the U.S. large cap equity space. So my economic exposure is always, 200%. If you kind of use that jargon leverage, I have 100% invested in bonds and cash. And then I use that, as you said, to collateralize. I don't margin it because I keep the money.
Yep.
There's a key difference there. So I put it on the balance sheet. I collateralize the swap. And so my counterparties allow me to do that swap unfunded.
Right.
So I have no counterparty risk up front. And then we can move collateral around as we need to earmark against gains and losses in the portfolio. So as the equity the equity market goes up, I have an embedded profit in my swaps. So now let's say I have $100 in my bonds, $100 in equities, but the market goes up 10%. Now I technically have 110 in equities, right? Because the market's up 10%, right? But that 10%, I make the counterparties, or they're obligated to, they're not scared of me, but we negotiate up front. They have to post up collateral. So we sit on that cash. It just sits there. It's earmarked against those positions. We don't touch it. We're not allowed to touch it unless they default on us. But that allows us to always make sure we're essentially roughly $1.
Well, Jeffrey, you just made my list of stacked return portfolios. We just wrote a piece called "Stacked Returns," how to provide excess returns in a low return environment. And what we did there is we sourced a bunch of mutual funds that have embedded leverage in it to do this type of thing, this portable alpha or whatever it is. And you guys had not made the list. I had no idea you did that. I think not enough practitioners are being loud and
I knew that
doing this, because it is quite a value.
But it probably make your screen fit the small fund. You're probably searching for funds under 10 billion or over 11 billion. We're just
it really is just tough to find that clear marketing that says we are using thoughtful, diversified use of leverage in order to create a stacking return environment that doesn't limit you to.
There's a tactical side to it as well, obviously.
Yeah, no, for sure.
Also, if you love this, and you know what you're doing, why not sell some calls against the S&P against it? If you really want to stack, right? If you want to do it, and maybe we'll do something like that one day, and I'll let you take that idea and run with it. But why not sell a few calls on an index space if you think you have a smarter mousetrap, right? And you can opt in. You don't sell the whole portfolio away. Sell 25, sell 30%, sell 10, whatever you need to get just a little bit there. As long as your basis is pretty tight between what you're selling options on and the portfolio, it's not a bad idea. The risk to this, as always, is you have a liquidity event. You had something like March of last year. Investors thought we were crazy, right? Bond portfolio, high quality bond portfolio goes down like 6%. Stock market goes down 30. There's the, oh my God, you're levered. You're leaving.
You got a 36% drawdown. Yeah.
Yeah. And it's like, oh my gosh, what have you idiots done? And give me all my money back. Fortunately, I had a webcast probably about 3 weeks later. And I'm like, look, if you like this strategy, the bonds are dislocated. The price is impaired. The bonds are not impaired. There's quality here. And if you believe we're going to recover the bonds, that's 6% of alpha just sitting there, right? And if you have any semblance of investment in strategy, and so, again, coming off the bottoms, it's easy to say, look, we outperformed. We definitely underperformed the S&P for about 5 or 6 weeks there. But just watching the bonds come back, I mean, a lot of it was kind of a no-brainer. Again, folks like us that know what's in the portfolio, it's harder for an advisor or someone to do that. But investors in the strategy, we told them, look, it's a great time. This isn't just because we're down. Here's why. This was liquidity. This is not structural default environment. And look, we're not epidemiologists. We don't know what's going on the pandemic front. What we do know is cash flows, and the cash flows don't look in, especially with the liquidity the Fed just gave you. And so we're going to get through this. Could I tell you the bond portfolio will take 12 to 18 months to come back? Little did I know it will be 6, right? So, there's times where, these type of things work. You just got to be careful. And that's where you have to be calculated in how you stack those.
For sure.
Make sure they're not highly correlated, right? That's like why, Mike asked me earlier, the 4%, you want to buy a little bit of high yield compared to U.S. equities. Yeah. But when bad things happen, both sides are going down. So we call that the Texas hedge here. It's a phrase that's used long and long. Yeah, you get a perception of diversification, which you realize you're exposed to the similar effect.
Exactly. It ends up being equity markets in drag at some point, right? But with slightly different recovery profile. Yeah.
I'm sure we could still see that, so that's why I'm again, these types of Texas are going to come after me with all this stuff.
We're all in trouble now.
Yeah.
That's a good way to hit back, at all the migration from your home state to,
you pointed that out though. I was attending my, graduation. It was in Texas, and we were, it was the area before. And for some reason at high school graduation, they don't give you drinks beforehand, which I found strange. The only party I've been invited to, there's not a cocktail hour before the graduation. And someone there, it's a rural area in Texas. And they said, look at all the people migrating from California, look at all the bad things that happened. And it was in a strong Texas accent. And I said, you can have them. We got to be a piece of this. Wait till they get there and they bring their politics to see you. You may not be as happy as you are today with that. So, again, kudos to our friends in Texas taking those people. I still live in the high tax regime here. And it looks like there's no inside in that, but there are some benefits to living in California.
I was just thinking that this morning. As everybody left California to Texas, how Texas all of a sudden becomes a much more liberal state.
If you don't believe it, look at Austin, right?
Yep. Austin is very, very much liberal.
And look, none of us are a fan to pay more than half of our income in taxes. I know Canadians do it too. Like there's a lot of places out there, but at the end of the thing about Austin, the infrastructure is lacking. Well, there's no taxes, right? There's nothing to do. Now, granted, some of the in LA, they look like there's no. I mean, we widened the 405. It was on. There's all these things about doing it. It was called Carmageddon. They shut it down for 2 days twice. Where people are taking flights from Ontario or from Burbank to LAX, which is like, I don't know, maybe 30 miles at most. as a profile, it's quite 15 just to get over that hill. It's like you can go around. There's another way to get there. But anyway, so there are things, I think people get upset with the politics, which I think we're all tired of politics in general. But, there are some benefits. And at the end of the day, look, I'm not here voting for higher taxes, but, I don't complain too much. I'm fortunate for what I have. And, look, let's all be better to one another. But if I want to complain about something, it's the divisiveness in this country and people, not treating each other with respect and equitably. If we could do that, that would be the message I'd want to get across to people versus all the other things we argue about in politics. So give me a leader like that tries to help everybody and tries to do that. And, potentially we can have a better place.
Jeffrey Sherman, Phil President.
Do it. I know. I will not. On those elections.
I've heard that. Everybody, I was listening to the All In podcast there, which I know is famous in the West Coast and trying to push Chamath Palihapitiya, an old Canadian dude trying to run for governor. Yeah, some interesting, great ideas.
He's got some great ideas. He's got great ideas. He's got some wacky ones, and, look, I mean, kudos out there. He sticks his neck out, like he's made a ton of dough, being an entrepreneur. And, look, I don't fault people like that, and look, if you had a front mic on me all day long, I would have a lot of enemies too, right? Say something that's going to offend somebody. And, at the end of the day, we're all trying to do the best we can. And that's part of this business too, right? Be a good investor, help your clients out, listen. And that's what we try to do. We build strategies not because, we're going to put some label on them. I mean, I bought the smart beta moniker. You know what? I said make culpa at one time. I acquiesced and just said, look, this is ubiquitous. No one knows what the hell it means. Right? Like I read with smart beta revolution, and I'm like, no one knows what it is. It's just quant investing. It just there's stuff. If you want to call it that, great. And where I really where I acquiesced the most, so I hosted a podcast, I don't know, about 5 years ago. And I'm like, look, smart beta meets smart alpha, right? If you want that, let's study it and just try to add some value around that smart beta process, which is that strategy.
Right. Yeah.
So, look, some things you embrace, some things you can't fight City Hall and you have to accept it, right?
Yeah. No, I love that. Look, that language game is absolutely crucial. I remember Cliff Asness also railed against it, right? Eventually you have to, whatever is accepted by the public that makes them feel better about diversifying into things that seem, to be useful. It's not a bad thing.
Well, there's a couple of things about that. One is that if you really want to see how caustic that Cliff can get, look at the presentation we gave to the Q group in the early 2000s against Bob. And, if you Google those together, Q group and all of that, you will find an amazing presentation. And, he even has a little jab at Siegel in there, but in general, Cliff is a brilliant man. I would never want to get him on my bad side.
Oh my God, no.
Kudos to him what he does. He's sharp with the tongue. But as you said, the nomenclature is important because people embrace it. And I used to want to die on the hill for things like this. And I have a friend who's a linguist and he's fluent like dozens of languages. I mean, dozens, and things that aren't related. It's not just, like Spanish, Italian, Latin, and like all those. I mean, he knows Arabic, he knows, Hebrew, he knows English, and feel free to always mention that. But, he teaches these things. And he told me once that you don't get caught up in that nomenclature because society defines what words mean and how you use them. And so the one I'm still rebelling against is advisor with an E. That's all the time now. Our style guy, at DoubleLine says to use them. Like, no, those are the things. But, the thing about, doing all of this is that, if you build the things you think are useful and you listen to client feedback, you listen to what people want, that's what makes you a successful investor too. Do the things you want to do, but package it how they want to listen. You can think you have a brilliant strategy, but if no one wants to buy it, you're just going to be another academic. And there's nothing wrong with academia.
I'm learning how to say stochastic less after this, for example. right? Never going to do that.
I mean,
No, that's right. I was like, that's exactly what Mike's been telling me for 15 years. I'm finally going to listen because it didn't come from Mike.
yes, well, you get distill ideas at their core. You keep them simple. You listen to people, and still, be honest. Don't go out there. Don't slap a name on something that doesn't belong. Don't try to chase bad. Stick to your knitting. Do what you do best. And look, it'll make you a good investor. If you're an advisor out there and you're listening to this, you're still listening to us after this random conversation. It's very sympathetic in nature, right? And you're asking, what do I do to be a better advisor? Listen to your client, right?
Yeah.
Listen to what they need. Listen to how you can help them. Your first conversation should not be, this is what I think you should do. It should be, how can I help? What's on your mind today? And that's what I've learned through travel over the years, listening to clients and building things is trying to listen. And it makes us be better architects of products and design, right? Because it's not that you're just giving them something you don't believe in, but if those two things can, in the Venn diagram, overlap, that's how you have a very successful business.
Amen. Get very much behind that.
On that note,
Yeah. Jeffrey, that was amazing. Thank you.
Yeah.
So much.
We covered stochastic processes, commodities, equities, fixed income, currencies, how to save the world via ESG, how to be a better person. I feel like it's a wrap, fellas. What do you think?
I agree. I guess even everything.
Well, thanks for helping. I really appreciate spending time with you guys today. Hopefully we answered some questions. Hopefully the advisor community gets some use out of this and, it makes them, at least think about some of the ideas we put out there today.
We got one last question.
Hit me.
It's another would you rather question.
Okay.
Would you rather spend a week in the past or a week in the future? And why?
I think I'd rather spend a week in the future. I've already lived the past, right? Unless you're talking about someone else's past, right? I mean, we're all a function of our own experiences, right? So
Yeah.
I'll give that as food for thought. Think about a colleague, think about a friend, think about someone you just met, and you say something like, wow, I can't believe you think that, or I can't believe you said that. And you have to remember that not everyone had the same experience. In fact, no one had exactly the same experience and path as you. And so from that perspective, we're just all a function of our own experiences. And so I'd rather see the future and see what it holds. And I think it's a beautiful place. I think we learn. I think we continue to, adapt. And there's been a lot of reports of the demise of society, a lot of demise of economies, and thus far they haven't become true. So I'm going to bet on the human ingenuity, the human spirit, and I'm going to bet on society, right? Because that's the social fabric. The roots of the words are the same. It's social. And so we all can get together for better causes. And so remember, that's what society is. So the short answer is I'll take a week in the future, and I'm going to assume it's a much better place than it is today.
Fantastic answer. Love it.
Shazam. That was great. Thank you, Jeffrey, for sharing that. And thank you so much for your amazingly valuable time.
All right. Well, thanks, guys. I appreciate it. That didn't even seem like it was an hour and a half almost. So, fun. So thanks for the interesting dialogue, and I wish you guys all success.